In this video, we will discuss about what are the 3 ETFs that you should hold for a long-term investment and the other assets that you like to invest in your portfolio. So stay tuned. I want to introduce you to a concept of portfolio allocation, which is a very important topic in the wealth management. Now, when you look at the graph, you will see a core portfolio is a part of portfolio allocation, which comprises of a huge chunk around 80 to 90%, while satellite portfolio is a small chunk which comprises 10 to 20%. It is very important to understand the key characteristics of the core portfolio and the satellite portfolio. As I said before, the core portfolio basically comprises of a huge chunk, roughly around 80%, while satellite is only 10 to 20%. Now, another thing is you have to remember, since the core is a huge chunk, it has to be invested into defensible assets, into passive assets which are basically stable and gives market aligned return, so that your overall returns are basically in line with the market and there's nothing high volatility or anything like that. Now, another thing, in the core portfolio you also have to realize that you have to select the assets which have a low risk and the cost is also low. Now, when we look at the core portfolio and the satellite portfolio characteristic, you will realize that core portfolio is basically invested into an assets which are passive in nature, which gives you a stable returns and which have a low risk. These are very important things that you have to keep in mind when you are basically building core part of your portfolio. You also have to keep that in mind that your core portfolio should be invested into assets which are broadly diversified, because diversification is key to reduce the risk. And on the core side, we are doing two things. We are first protecting our downside, means we are trying to protect our money which we have invested, and then we make money on that which is in line with the market return. So this is the key aspect that you have to keep that in mind. When we talk about the satellite portfolio side, now satellite is a quite interesting thing, because let's just say you want to invest into crypto, you want to invest into high yield things, or you want to invest into exotic assets. These are the assets which have a high return potential, but you have to keep that in mind. They are very risky, they are very volatile, which means there are huge chances of you making loss in those assets. So how we can keep them in our portfolio? So the best way is invest into these assets, but it should be a part of satellite portfolio, because satellite is the part of the portfolio which is very small, and even if we get a hit, the core portfolio is gonna protect our returns and broadly basically keep our money intact. As you can see in the graph, that the investment nature of the satellite portfolio is active. They are invested into an assets which are concentrated, which are focused on the certain sectors, certain themes such as crypto or anything like that. Then when you look at the return, as I said before, the returns could be potentially high, but the returns can be highly volatile. The risk is also going to be the high, because high the risk, high the return is. And the cost of investment is also going to be a substantially higher as compared to the passive assets which are being held in the core portfolio segment. So you have to keep that in mind when you are investing into exotic assets, or you are investing into crypto or any other kind of financial instruments. These kind of assets gonna have a high return potential, but they will also gonna be very risky. They're gonna be very costly. And the best thing for you to invest is basically invest in them, but make them a part of your satellite segment of the portfolio. Don't move them into your core portfolio, because your core portfolio should be diversified, should be invested into low cost, low risk assets. So your money is protected. I'm saying again, so your money will be protected and you should be making a return which is in line with the broad market. Now that you have learned the concept of portfolio allocation and you know how to allocate your money towards the more stable assets and towards more exotic assets, I want to introduce you to our very first ETF. This category of the ETF is called broad ETF. What is broad ETF? So broad ETFs are the ETFs which basically track the performance of broad index. The index could be S&P 500, it could be NASDAQ, it could be Russell, it could be MSCI, or it could be any other broad index. For you to get more information, I basically have done the comparative analysis of 4 of the biggest broad ETFs in the market. So when we look at the broad ETF that I have selected, which is Vanguard, S&P 500, SPDR S&P 500, iShare Core S&P 500, and Vanguard Total Stock Market ETF. So things that you have to basically consider when you are looking to invest into an ETF. So in this case, now that we are looking into a broad ETF, so I will tell you what are the things that you have to look on. So first, look at the AUMs. The VOO is one of the biggest ETF with $674 billion of assets under management. The next one is SPY, which is managing about $625 billion, and the rest on. Now, another thing that you have to keep that in mind when you are looking at the ETF is basically the expense ratio. So look, except for SPY, which cost is about 0.9%, rest of the cost is pretty much the same, which is 0.3%. Now keep that in mind when we are also looking at the broad ETF. You also have to look at the dividend yield. A dividend yield is basically something that when you invest into an asset, how much the cash that you will receive during the year. So in the case of all these broad ETF, the percentage is pretty much same, around 1.3%. So that means, let's say if you invest $100 today, after 1 year you will receive about $1.3 cash in your account. Now this is some of the things that you have to look for: the size, the expense, the dividend yield. Now the second really important part which I really want to discuss with you is the risk profile of these ETF. And for the risk profile, I basically have selected 3 metrics. Number 1 is Sharpe ratio, number 2 is Turner ratio. These 2 ratios basically will give you a pretty good idea about risk adjusted return. What is risk adjusted return? Which means how much an excess return you will be making for taking an extra 1 unit of risk. So when you are comparing different assets and you are putting these numbers, so higher the number of these ratio, the better it's gonna be the risk adjusted return of that asset. And beta is simply the correlation of these assets with the market. In a simple term means, let's say if the market moves 1% up, one mean that this ETF will also gonna move with the same percentage, exactly the 1% with the market. Now, back to risk metrics. So when we look at the Sharpe ratio and the Turner ratio, we'll see that they are pretty much the same across the first 3 ones, except for Vanguard Total Stock, which is slightly low. And again, when you look at the Turner ratio, it is pretty much the same except for the VTI, which is Vanguard Total Stock Market ETF, which is quite low. It could be because the Vanguard Total Stock Market ETF is basically tracking the overall market, while the first 3 ones are basically tracking the performance of S&P 500. Could be one of the reasons. And when we look at the beta, which is basically a correlation of these assets with the S&P 500, it is exactly 1. So that means for every 1% change in the stock market, these ETF will exactly change with the same percentage. Now look at the return performance. So for the return performance, I basically put the 3 different timelines. Number 1 is 1 year return, then you have 3 year return, and then you have a 5 year return. Now, amazingly, since all the ETF are basically tracking the broad market, the returns are pretty much the same for 1 year, again for 3 year, and again for 5 year. Now, the other thing that you also have to basically analyze is the sector holding, as what are the underlying sectors of the ETF. Now, in the case of broad ETF, you can see that all the ETF actually have a pretty same holding into all the sectors that have been listed here. So let's look at it. So finance is pretty much the same, 15% across all 4 ETFs. Then you have electronic technology, again almost 22-23% same. Then you have the third biggest one is the technology services, again same, around 22%. So it's pretty much the same across the sector. And you know why all these ETFs actually have a similar weightage into a similar industries? Because these ETFs are actually tracking the broad market index, and the index has a similar kind of weightage into these sectors. Now, once you're done with your analysis of holdings of the ETF, you also have to look at the top stocks in the ETF, which is very important. So when we look at the top stocks which are basically held in these ETF, and you will notice that all these ETFs actually hold the same stocks at a very similar percentages. Just for example, Microsoft is actually common across the 4 ETFs at a same percentage, which is roughly 7%. Then you have Nvidia around 7%, then you have Apple around 6%. Now if I have to select one of the ETF for my own personal portfolio, I would select VOO, which is Vanguard S&P 500 ETF. And the reason is it is the biggest ETF with over $670 billion of assets under management and offers a slightly higher risk-adjusted return. Now moving to a second category, which is growth ETF. Now let's just say you are interested to invest into growth sectors and you want to invest into growth ETF. So look no further, because I have put top growth ETF into this diagram. So stay with me. So when you look at the growth ETF, so I basically have selected the top growth ETFs which are available in the market. So these are QQQ, QQM, VUG, IWF and MGK. The first thing that you will notice about the range of the AUM, that QQQ is the biggest with $347 billion, while MGK is the smallest one with only $27 billion of assets under management. The second thing that you will realize is the expense ratio is not constant. That was the case in the broad ETF. Here it's been quite diverse. So look, in the case of QQQ, it's 0.2. In the case of QQQM, it's 0.15. And the lowest one is the VUG, which is 0.04. Now, next thing that you will notice is the dividend yield, which is in the range of 0.4 to 0.6%. But if you have been keeping eye on this whole video, you must have noticed that the dividend yield for the broad ETF was a bit higher, which was in the range of about 1.2 to 1.3%. And why this is the difference? Glad you asked the question. Well, in the case of growth companies, the growth companies, whatever the profit they make, they reinvest into their business so they can grow. That's why they do not give a whole lot of cash to the investors. So the next thing that we will discuss is the risk profile of these growth ETFs. So when you look at the beta is actually quite high as compared to the broad ETF. If you remember, the broad ETF beta was around 1.00, but in the case of growth ETF, it is close to 1.11. And you know why? Because the growth companies are more volatile. As I said earlier in the portfolio allocation segment, that higher the return potential, there's going to be a higher risk. So that's exactly that you can see in the numbers, that when you look at the beta, it is quite high as compared to the broad ETF segment. And when you compare these growth ETF among each other on the basis of risk adjusted return, you will see that QQM basically offers the higher Turner ratio, about 13.27, while in the case of Sharpe ratio, the highest one is QQ and IWF around 0.78. Now moving on to a return profile. So when we look at the return performance for these growth ETF, you will notice over the period of 1 year, the return actually have varied between 14.4% to almost 16%. For the period of 3 years, you will notice the average annual return have ranged between 23% to 24.5%. And during the period of 5 years, you will notice that return actually have broadly moved in the range of 17% to 19%. And when we look at the best performing ETF for the 5-year period, that has been the MGK, which has basically given an 18.7% average return for the past 5 years. Now, another thing I want to highlight is when you look at the returns, you will notice that these returns are actually higher than the broad ETF. Why? Because these ETFs are actually growth ETF, and as I said before, growth ETFs are actually offers a higher growth potential. Now when we look at the growth ETF sector holdings, you will notice that there are few sectors in which all these ETFs are actually concentrated, such as technology services and electronic technology, and contributing about 60 to 65% of the portfolio. But when we look at the down, look, in the case of QQM, VUG and MGK, they have an allocation of roughly 7% to finance. Then they have also very small contribution to transportation sector, producer manufacturing, commercial services. But these allocation you will not see in the case of QQQ and IWF. And again, the reason being is, since these ETFs are actually managed, so the portfolio manager basically decides which area is going to be the high growth potential, which stock going to be the high growth potential, and based on that they basically make their own investment decision, which result that we can see in this diagram. Now moving on to our top stocks in the growth ETF. As you will notice that Microsoft, Nvidia, Apple, Amazon, Broadcom, Meta, Netflix, these are quite common names across the 5 growth ETF. But look at the weightages, like look at the Microsoft. So Microsoft weightage has been 9% to the all the way to the 13%. Same with the Nvidia, 9% to the all the way to the 12%. And then there are certain other stocks which are basically present in few of the ETF but are not present in other ETF. So just look at the example of Visa, MasterCard, Palantir. They are basically present in VUG, IWF, MGK, but they are not in the QQQ or QQM. So again, you can see that what the portfolio manager is basically thinking about, like which companies are the high growth companies which offer high potential for the return, and based on that they basically allocate to those companies. Now if I have to select one of the growth ETF for my own portfolio, I would select QQM. So the reason for me being selecting a QQM is because it offers higher risk adjusted return. Just look at the Turner ratio, and it also offers a higher 3-year average annual return of roughly 24%. Now moving to another segment of the ETF which are called value ETF. Imagine if you are looking to invest into an ETF which basically give you an exposure to a companies which are stable, which are defensive, and which move less during the bad time. So then value ETF is the right choice for you. So for you, I have basically already done all of the homework. You just look at the table and understand the different aspects of these ETF. So for the value ETF, I basically have selected 4 top ETF, which is VTV, VIG, SCHD and VYM. So when we look at the AUMs, you will notice that VTV is the biggest in the comparable with $137 billion of AUM. Now when we look at the expense ratio, that is the lowest with only 0.04%, while others are slightly expensive. Now when we look at the dividend yield is somewhere in between for the VTV, which is 2.2%, not being the highest, as the highest is being SCHT, but not being also the lowest, which is VIG of 1.8%, but somewhere in the middle. Now the interesting thing that I want to highlight, when we look at the beta, we will notice the beta is less than 1. So if you remember, in the case of broad market, it was 1. In the case of growth ETF, it was higher than 1, roughly around 1.1. But in the case of value ETF, it is low. So what does this mean? It means when the market actually decrease during the crunch time, the decrease in the value ETF is going to be slightly lower than the broad market. Or vice versa, when the market moves up, the increase in the value ETF is going to be slightly lower than the broad market. And when we look at the risk adjusted return metric, you will notice that VTV offers the best Turner ratio of 13.38, and the next being in line is VYM with 13.49%. And when we look at the Sharpe ratio metric, you will notice that VTV and VYM are actually pretty same with 0.74. So they are pretty much the same when we look at in terms of the risk adjusted return metric. Now moving on to a return performance. In the case of return performance, you will notice a stark difference for the 1-year period. In the case of VTV, the return is about 12%. In the case of VIG is about 13%. But in the case of SCHD is way down of 5.5%. And the highest is being offered by VYM of 15%. When we look at the return on the 5-year horizon period, Then you will also notice a stark difference, with the highest being VYM of about 18% and the lowest being SCHD about 13%, while VTV and VIG actually lie in between around 13% and the 15%. Now when we analyze the sector weight in these value ETF, you will notice that finance is being the dominant sector in these ETF, with the weight vary between 9% all the way to the 27%. Now the second one is actually the health technology, which actually varies between 10 to 16%. And now I really want to show you a difference in the strategy. So when you look at the VIG, you will notice they have exposure to consumer services about 3%, process industries about 3%. But when you look at the VTV or VYM, it doesn't have these exposures to these sectors. When you look at the VTV, VYM, you will notice that these ETF do not have exposure to these sectors. When you look at the SCHD, it has exposure to communications about 4%, industrial services about 5%. Again, these sectors are only in SCHD, but they are absent into rest of the ETF. And the reason, as I said before, it's because portfolio manager actually decides which of the sector offers the highest value, and based on that they take the allocation decision. Now when we look at the top stocks in the value ETF, you will notice a quite interesting item, which is that Berkshire Hathaway is about 4% in VTV, but it's absolutely absent in rest of the 3 ETF. Now look at the JP Morgan, which is roughly 3% in the VTV and 4% in the VIG, but it is absent in the SCHD. When we move all the way down, you will notice Broadcom, Apple, Microsoft, Visa, MasterCard, Costco, ExxonMobil, they actually are in the range of 2 to 5% only in the VIG. But they are not present in the rest of the ETFs. And these allocations are basically based on the decisions of the portfolio manager, which believe. So overall, you would have noticed a broad dispersion across stocks in the value ETF. And the reason being is that portfolio managers make a decision about which stock to pick in these value ETF, which offers the highest value. Now, if you ask me which is my best value ETF that I would select for my own portfolio, that is going to be hands down VYM. So the reason for me picking VYM is basically it offers a good dividend yield around 3%. It has lowest beta of 0.84 compared to rest of the comparables. Then it also offers a very healthy risk adjusted return based on the Turner ratio, which is 13.49, quite high as compared to rest of the ETFs. Now when you look at the return performance, so for the period of 5-year return performance, you will see it offers the highest return, which is roughly 18%, quite high as compared to rest of the ETFs. After discussing about 3 main categories of ETF and the 3 ETF that I would select for my own portfolio for a long term, I basically have put in some of the other ETFs. Now I have also put in some sector ETF which can be considered for the satellite part of your portfolio. So look, the first one is the tech ETF. In the tech ETF, I have selected 3 of the best ETF which are basically invest into semiconductors, cybersecurity and artificial intelligence. And you can look at more information by just pausing the video. Then we have also looked at the healthcare. So let's just say if you believe the healthcare is going to be a booming sector in the coming period, because most of the people are actually moving towards the older age. So this could be another sector that could entice you and make you to invest in it. So for that, I have selected 4 of the top ETFs in that sector. Again, if you are looking for the stable returns, then I've also looked at the utilities and infrastructure ETFs, and I've selected 3 of the best ETF in these sectors. One thing I really want to show you, that look at the dividend yield of these ETFs, that they are actually offering a quite an attractive dividend yield. For the illustration purposes, I basically have created 2 portfolios. One is growth focused portfolio and the other is value focused portfolio. For the growth focus portfolio, I basically have selected two of the ETF for my core portfolio holding, and which comprise of about 80%. And for the satellite part, I basically have selected the SMH, which is an AI as semiconductor ETF. And I have given a portfolio allocation of 20% to the SMH. Now, when you look down at the weighted average expense ratio of this growth focus portfolio, you will notice the cost is gonna be 0.09%. The dividend yield of the portfolio is gonna be 0.8%, while the beta is gonna be 1.14, and 5-year return average is gonna be 22.3%. Now you have to keep that in mind when we look at the dividend yield, that is 0.8%. But if you remember, in the case of broad market, there was roughly 1.3%. And the reason in the growth portfolio the dividend yield is less than broad market is because the portfolio is focused towards the growth sector. Now another thing I want to highlight is the beta. So the beta in this portfolio is 1.14, which is again higher than the broad market, which is 1. And the same reason is that growth companies actually offer higher return potential, but they also possess more risk, which is being reflected in the number of beta. Now let's just say if you are more conservative investor, or you're moving towards the retirement and you want to create a portfolio which is more stable, more defensive in nature. So what you will do is you will create a value focused portfolio. So for the value focused portfolio, I basically have selected VOO and VYM for my core holding, which is roughly 80% of the portfolio. And for the satellite part, I have selected an IGF. This is an infrastructure ETF, which is a very stable ETF which offers a good dividend yield. And when we look at the portfolio expense ratio, you will see the ratio is 0.12%. But interestingly, when you look at the dividend yield, that is 2.2%. So you will notice the dividend yield of value focused portfolio is higher than the growth focused portfolio, which is 0.8, and it is also higher than the broad market portfolio, which is 1.3% approximately. Then again, since you are investing into value focused portfolio, look at the beta, that is 0.9. That is less than both broad market and the growth ETF. So it shows that portfolio is working and it will provide stability and defense during the market downturn because the beta is actually low. But at the same time, when market moves up, it's gonna move low as compared to the broad market. Now when we look at the return 5-year average, you will notice that portfolio basically offers a 5-year return average of 16.2%, which is actually lower than growth focused portfolio. Why? Because value is actually more defensive and more stable. Now I hope you enjoyed the video, and if you have any comment, if you have any suggestion, or if you want to ask any question, please share your questions in the comment section, or you can also email me.